Hello, everyone, and good afternoon. On behalf of Foley, I'd like to welcome you all to our next installment of the Employee Benefits Broadcast webinar series. Thank you so much for joining us today. Before we get started on today's presentation, I'd like to go over a few housekeeping items. For those of you that may have questions about any of today's topics, we invite you to type them into the Q&A box on your screen. We will try our best to answer all questions at the end, time permitting. However, if we do not get to all of your questions today, we will be sure to follow up with you via email. If you experience any technical difficulties with the webinar platform, please refresh your browser or see the webcast help guide on your screen. You can also request a dial-in number by emailing me. My name is Caroline Hogan, and my email is khuven, Khuven, @foley.com. For those of you that are seeking CLE credit today, please enter the CLE code when it is announced later on in the presentation. Note that if you are seeking Kansas, New York, or New Jersey CLE credit, you must also fill out the attorney affirmation form, which is located on the resource list widget. Foley will also apply for HRCI credit today after the program. No need to submit anything for that outside of formally registering for this webinar. A copy of today's slides are also available in the resource list widget. And as a final note, a short survey will appear on your screen. We would appreciate it if you provided us with any feedback on today's webinar to help us improve our future webinars. And now I will introduce today's speakers. First, Casey Fleming is a partner with the Employee Benefits and Executive Compensation Group. She focuses a large portion of her practice on helping clients with their executive, incentive, and equity compensation goals and challenges. She also provides clients with qualified retirement and welfare plan support and plays a key role in corporate mergers and acquisitions with values ranging from $25 million to $2.5 billion. An interesting fact about Casey is that she recently earned her black belt in Taekwondo. Next, Nick Welle is a senior counsel with the Employee Benefits and Executive Compensation Group. He focuses 100% of his practice on health and welfare employee benefits with a focus on the Affordable Care Act, HIPAA, COBRA, ERISA claims and appeals, and account-based plans. A fun fact about Nick is that despite years of trying and the use of several informal coaches, Nick has never been able to whistle. If he ever figures out how to whistle, he has promised to whistle live during his next webinar. And last but not least, Caroline Hogan is special counsel and a litigation attorney. She represents and counsels employers on all aspects of compliance with the myriad of federal, state, and local employment laws, including discrimination, harassment, wage and hour, and leaves of absence. She has extensive experience representing employers in federal and state court and before governmental agencies, including the Equal Employment Opportunity Commission and Wisconsin's Equal Rights Division. A fun fact about Caroline is that she caught a 45-inch muskie in northern Wisconsin this summer. With all that, I would now like to turn the presentation over to Casey.
Great. Thanks, Kayla. And welcome, everyone, to today's installation of the Employee Benefits broadcast. As most of you already know, today's presentation will have three parts. I will kick off with a refresher course on incentive stock options and a bit of commentary about whether companies will start to provide them more often, considering certain changes made by the most recent round of tax reform. Then, I will hand the presentation off to Nick to discuss the Affordable Care Act and certain strategies related to everyone's two favorite things, reporting and audits. Finally, Caroline will round us out with some great tips and best practices to keep in mind when drafting an employee handbook. As I mentioned, I'm going to start my presentation with a quick refresher course on ISOs, why and how they're different from regular non-qualified stock options, how they need to be structured, and how they're treated for tax purposes if certain requirements are met. Then I'm going to conclude my segment with a discussion about why companies may not have historically used ISOs as much as you may think, and whether, as some advisors and practitioners believe, companies will start issuing them more often because of some of the changes that were made by the Tax Cuts and Jobs Act. So what is an ISO? Well, it's an abbreviation of incentive stock option, which is a special type or subset of stock option. So let's break that down a bit. As most of you probably already know, an option, at its most basic, is simply the right to purchase shares of a company's common stock later for a price that's equal to the value of the stock underlying that option now, or technically on the date of grant. Because an option is exercisable for a specified period of time, but for that fixed price, it enables employees to delay exercise, or the date on which they actually are able to purchase those underlying real shares of the company's stock, while they wait and see if the underlying stock will appreciate in value, and by how much. If the value of the stock goes up, then the executive exercises the option to purchase that stock. But instead of paying the fair market value of the underlying stock on the date of the purchase, the executive gets to pay the presumably lower price that was established when the option was granted to her. If the value of the stock declines after issuance, then the executive can forego the exercise of the option. Obviously, this is much less risky than buying the stock on the grant date and then holding it, because it allows executives to wait and see before handing over any cash and without any tax consequences. So that's options. And then ISOs are a special subset of options, because as we'll discuss in more detail in a bit, they may result in more favorable tax treatment to executives than a normal non-qualified stock option. And the flip side of that is that they may also lead to less favorable tax results to a company, the employer, which is one of the reasons that some employers choose not to issue ISOs. So let's get into the nuts and bolts a bit. In order to qualify as an ISO, the option plan and related award agreement must include certain terms, and the option must be managed in a certain manner, all as outlined under Internal Revenue Code Section 422. First, the option must be issued pursuant to a plan. This is usually easy for employers to manage because they generally, and we would recommend, incorporate the ISO provisions into their more general or omnibus equity incentive plan. In addition, the plan must state the number of shares that are reserved for issuance of ISOs. Again, this is pretty easy, as it's usually accomplished by simply stating that the full number of shares that are generally reserved for issuance under the plan may be issued as ISOs. It doesn't matter if you know right now that some of them will not actually be issued as ISOs and instead will be issued as non-qualified options. What this strategy does is allow you to reserve the full number and never get caught accidentally issuing more ISOs than you originally reserved. Unless, of course, you blow through the general reserve, but that's a whole different issue. So the next one's a pretty big one, and it's that ISOs may only be issued to employees. That means no non-employee directors, no consultants, no advisors, only employees. And though I didn't stick it on a slide, you should also note that ISOs may only be issued by corporations. So there may not be issued by LLCs or partnerships. So once you have the plan in place, it must go through an additional approval process that would not normally apply, at least in the private company space, to an equity incentive plan that is not issuing ISOs. The plan must be approved by the company's shareholders within 12 months before or after its adoption by the company, and then reapproved every 10 years thereafter. Some other terms that are typically included in the award agreement include the exercise price, which to qualify as an ISO must be equal to an amount that is at least the fair market value of the underlying stock on the date that the option is granted to the employees, or the grant date, or 110% of that fair market value if the ISOs are being issued to anyone who's already a 10% owner. In addition to the 10-year approval process for the plan itself, the underlying awards must each also include a 10-year term, or 5 years for those 10% owners. This simply means that the last possible day that those options may be exercised will be the day prior to the 10-year anniversary of the grant date. Notably, if this deadline is missed, the entire option is void, the entire option. It does not simply switch to a non-qualified stock option status. In addition, many awards are structured such that they satisfy the statutory requirement that no more than $100,000 of ISOs may vest, or more specifically, become exercisable in any given calendar year. The example on the slide is pretty straightforward. It explains a situation where an employee has been granted $400,000 worth of ISOs as determined on the grant date, and then a quarter of those ISOs vest over a 4-year period, such that only $100,000 become exercisable or vested in a particular year. That's a pretty straightforward example, and it makes it seem pretty easy to apply this requirement, but this can get tricky in certain circumstances where companies choose to accelerate the vesting of the awards, for example, in connection with a change in control. So in our example, if the company underwent a change in control in that first year and accelerated the vesting of all $400,000 worth of the options and the employee exercised, then only $100,000 of the ISOs would be subject to the ISO status. But unlike the term limit, this is not an all or nothing requirement. So if more shares become exercisable in a particular year, then the excess is simply just automatically treated more similar to a non-qualified stock option for tax purposes. There are 2 additional requirements that may or may not be specified in the award material, but are important to communicate to executives. First, there is a limit on the exercise period after a termination of employment. So in the context of a normal termination, ISOs must be exercised within 3 months following the termination date. Longer periods are available in the case of a termination due to death or disability. In addition, the plan or award agreement may permit the employee to exercise after this 3-month period, but in that case, the options will be treated as non-qualified stock options. As a result, many award agreements will simply hard code the 3-month requirement into the terms of the option award to make it a contractual obligation to exercise within that 3-month period. Second, ISOs are only eligible for our special tax treatment if the employee holds the stock that's issued following the exercise of the option for a certain period of time, specifically through the later of the date that is the 2nd anniversary of our grant date, or the date that is 1 year following the date of exercise. If that holding period is not met, then the options will be treated similar to a non-qualified stock option. They are not completely voided. As reflected on this slide, especially if these requirements are not included in your award agreements, it's very important that you communicate them to your employees and executives so that there's no surprises about tax treatment if they fail to adhere to them. This next slide includes a busy and comprehensive chart that compares the tax treatment of ISOs and non-qualified options at certain key events: grant, exercise, and sale. I'm just going to run through the 2 key differences here. First, executives will not recognize any ordinary income tax at exercise if an ISO, as compared to the non-qualified option, which does require executives to recognize ordinary income on the spread, or the difference between the exercise price and the value of the option on the date of exercise, and come up with the money to pay their withholding on the amount in addition to the exercise price. This is a really big deal because even though the executives will have to pay over the cash to exercise, they won't have to come up with that additional tax money. And it can be a really big benefit for executives, unless, because of their exercise, they trigger the alternative minimum tax. And unfortunately, prior to the most recent round of tax reform, it was fairly likely that executives would trigger that alternative minimum tax when they would exercise their incentive stock options. But as we'll talk about in a bit, that may be changing. And for those of you on the phone who aren't readily familiar with AMT, it's just an alternative tax structure pursuant to which the IRS will evaluate your income under the standard income tax method, and then the alternative minimum tax, and then just assess you whichever amount is more. This is relevant in the ISO context because, as we talked about, executives will not recognize income tax when the ISO is exercised under the standard income tax structure, but that spread, again, the difference between the exercise price and the value of the option on the exercise date, is taken into consideration when calculating whether or not the AMT will be triggered. Therefore, the larger the spread, the more likely the AMT will apply. The second big difference is if the holding period and all of these other requirements we've talked about are met, then the gain, the difference between the exercise price and the ultimate sale price, will all be taxed at the lower capital gains rate, and no FICA or withholding obligations will ever apply. This is a really big deal from a tax planning perspective for savvy executives because it means that ISOs are an incentive compensation vehicle, in fact, the only incentive compensation vehicle that provides employees with compensation that will never be subject to ordinary income tax or FICA, only the more favorable capital gains rate. As you'll note on this next slide, the tax treatment is a bit of a different story for employers. For an employer, ISOs are less valuable from a tax perspective than their sometimes more common non-qualified stock option cousin because if they're structured and managed correctly, as we've been talking about, they will not result in a tax deduction for the corporation. So this may matter a lot to some companies and is one of the reasons, as we'll talk about, many companies have decided not to issue ISOs in the past. But it's not as big a deal for others. For example, a startup company that might not recognize income at all for a few years, or a large publicly traded company for which a deduction on a $100,000 award is less valuable than giving their executives the opportunity to maximize this kind of tax planning. So as I've alluded to throughout this presentation, some people have thought in the past that ISOs simply are not worth it, even though they have this kind of cool tax treatment for executives. They have our complicated tracking and tax reporting requirements. Even though executives aren't subject to our standard income tax when they exercise, sometimes then they are still subject to the AMT we discussed. In practice, some of our clients say that few of their employees even satisfy the holding period. This comes up a lot for some of our private companies who tell us that their employers or their employees are not exercising their options as they vest, and instead they're simply holding them until there's a capital event, like a change in control. And if the employees are waiting like that, they're never going to be able to take advantage of the ISO tax treatment because they're not going to satisfy that holding period requirement, because the exercise of the option and then the subsequent sale of the underlying share will likely happen pretty much simultaneously. And finally, as I just mentioned, the company won't get a deduction for significant compensation expenses. But has this changed now that we have our most recent tax reform? Maybe, but we don't think probably on a really large scale. The reason that it might change for some employers and why we're talking about this is because the Tax Cuts and Jobs Act did make some changes that will allow for more favorable treatment for ISOs and maybe make them a little bit more attractive to employers and employees. First, the tax reform bill made changes to the AMT that make it less likely that the ISOs will trigger that AMT, that tax that might get triggered at exercise. And as a result, more savvy employees might start making more requests for ISOs now that if they know that they're less likely to trigger that AMT tax. Second, long-term capital gains rates, that 15% or 20%, depending on your income bracket, have not changed. And even though our ordinary income tax rates were reduced, the difference, especially for higher income taxpayers, is still really meaningful between that capital gains rate and the ordinary income tax rate. Finally, and perhaps most notably, the corporate tax rates were reduced. And as a result, it makes that compensation deduction that is not available in the context of ISOs less valuable. Of course, we still have some of our ongoing and historic challenges. They're still not incredibly well understood or managed by employees. AMT is still possible, just less likely. The holding period and the $100,000 per year limit still create some restrictions in terms of how the ISOs are managed. But we still think it's important to understand the nuts and bolts of ISOs and include them in any conversation when reviewing or discussing compensation strategy with companies or negotiating with executives, especially in cases where the company may have previously made a decision not to issue ISOs because of some of the factors that had been changed, for example, the value of that tax deduction. So with that, I will hand it over to Nick to talk to us about the Affordable Care Act. Nick?
Thanks, Casey. So now we're going to completely shift gears here and dive into two areas of the law where enforcement has really been heating up lately. The primary focus of my presentation today will be the IRS's enforcement of the employer mandate and how you can avoid letters from the IRS issuing proposed penalties. And then after that, I'll just take a minute or two to discuss HHS enforcement of HIPAA. So without further delay, let's dive right into it. I wanted to provide a little bit of background first. I hope you're all familiar with the TV show Mythbusters. If you're not, you got to see it. It's a pretty cool show. They would do these scientific tests to see if myths were actually true. So like my favorite one was if a car could really skip over water if it drove really fast, just like in the movies. Well, here's my very own version of Mythbusters, but instead of talking about whether a combination of soda and Pop Rocks can make your stomach explode, we're going to talk about something a lot more fun. We're going to debunk the myths around the ACA. So first, myth number one. Isn't the employer mandate going away? The answer is no. It is true that the individual mandate will be going to $0 effective January 1, 2019. So essentially, the individual mandate has been repealed effective 1/1/19, but the employer mandate has not been touched. And based on the industry groups and political consultants that I follow, it will likely not be going away anytime soon. One of the biggest reasons for that is because the employer mandate is projected to generate revenue around $100 billion in 10 years. Yes, that is billion with a B. So this makes it really unpopular for any politician, doesn't matter what side of the aisle the politician is on, to support the repeal of the employer mandate on a standalone basis because arguably it would increase the national debt by $100 billion. So the moral of the story with this first myth bust is that you shouldn't neglect your ACA employer mandate duties. All right, myth number two. I thought we don't have to do the ACA tax forms anymore. Nope, not true. ACA tax reporting remains. There is a chance it might get simplified due to the effective repeal of the individual mandate, but there hasn't been any formal legislation on this point yet. So point here is continue to be diligent with your ACA tax forms. Myth number three, the Trump administration isn't going to be enforcing the ACA. It is no secret that the Trump administration is not a big fan of the Affordable Care Act, and it has passed rules to circumvent or relax certain ACA regulations. But the employer mandate is being enforced by the IRS. I'm going to get into it in more detail on a few of the slides coming up, but the IRS is currently enforcing the employer mandate for the 2015 calendar year, and they have identified around 50,000 employers that might owe proposed penalties for the 2015 calendar year, with a total of possibly just over $4 billion in possible penalties. So take-home point here is that the IRS is very much enforcing the ACA's employer mandate. The last myth: if I don't report, they can't find me. This is also not true. Actually, the IRS is currently in the process of sending out what are known as non-filer letters. These are letters being sent to the employers who the IRS believes are large employers who should be reporting, but are not. And the IRS is using W-2s submitted to the IRS by these employers to try to take an estimate of how many full-time employees they have. Not to mention, there also are separate set of penalties for failing to do the ACA tax reporting. And that penalty is roughly $500 for each form that should have been furnished and filed. And that can add up, as you can imagine. So if you are a large employer, quote unquote, which for general purposes is an employer with at least 50 full-time employees, including your full-time equivalents, you should be doing this reporting. All right, I want to provide a little bit of background on the employer mandate. These rules have been around for a while now, and you're all probably familiar with them, so I don't want to waste too much time here. But I also wanted to briefly discuss these terms so we're all speaking the same language, if you will. So really quick, there are two separate requirements under the employer mandate if you want to avoid potential tax penalties. And there are two very different set of penalties. On a very high level, the first requirement there on the slide is that the employer must offer health coverage to 95% of its full-time employees and dependents. That percentage was 70% for 2015, but it's been increased to 95% for all subsequent years. I call this penalty the sledgehammer penalty because if just one full-time employee receives a premium tax credit on the marketplace, then a penalty of roughly $2,000 applies to each and every one of your full-time employees. There's a special rule under the ACA where you get to reduce your penalty count by the first 30 employees. So essentially you get 30 freebies. But on a general basis, the penalty applies to your entire full-time population. The second requirement on the slide there, that is the requirement that the coverage that you offer must be affordable and meet a certain actuarial standard known as minimal value. The primary challenge here with employers is the affordability piece. We don't have too many clients dealing with the minimal value component, which is why I call it the affordability requirement. And I could spend easily 30 minutes talking about what affordable means, but on a really high level, what we're talking about is an analysis of the employee's contribution towards health coverage relative to that employee's earnings. I call this penalty the tack hammer penalty because it only applies to those full-time employees who are not offered affordable coverage and who actually enroll in coverage through the marketplace and receive a premium tax credit. So your exposure here is much more limited. Your penalty maximum can really be low if you only have a few employees who actually get subsidized coverage through the marketplace. Again, I don't want this to be a treatise on background on the ACA. You're probably all somewhat aware of the forms, but let's just do a very quick summary again so we're all talking the same terms. I think I'll do this in reverse order. On a general basis, that Form 1095-C is pretty much your W-2-like form that must be issued to every full-time employee. If you're self-funded, you have a few more reporting requirements for it. But for our purposes today, the Form 1095-C is essentially your W-2 for ACA purposes. It essentially reports whether that specific full-time employee was offered affordable health coverage. And then the Form 1095-C is just a 3-page form that essentially acts as a cover page for the IRS and reports aggregate data to the IRS. So you slap on that cover page form on top of all those 1095-Cs. And so this is a biggie because this form indicates whether the employer has complied with the 95% offer requirement. So I know what you're thinking. Nick, you ding-dong. Why are you wasting all this time giving us background? We're all familiar with these rules. But I took the time just to give a little bit of a summary on these things because it all ties together. As I mentioned earlier, the IRS is now enforcing the employer mandate. To determine proposed penalties, the IRS is using the information reported on these tax forms. So I want to repeat this because I think it's worth emphasizing. In the eyes of the IRS, it does not matter if you worked incredibly hard to comply with the employer mandate. If you reported incorrectly and somehow indicated on your tax forms that you are not in compliance with the employer mandate, the IRS might send you a letter assessing proposed penalties because it is just using the information that you reported to make these determinations. So if your forms are incomplete or inaccurate, the IRS might send you one of these letters even though you don't deserve one. And unfortunately, these are new and complicated forms, so whether it's been done internally within the employer or an employer has used a vendor, for whatever reason, some of these IRS forms have either been incomplete or inaccurate, and that has triggered IRS letters assessing proposed penalties. As I previously mentioned, the IRS is currently enforcing the 2015 calendar year and has identified about 50,000 employers who might receive a letter. The last I heard, I think they've physically issued over 30,000 letters already to employers. So the IRS is casting a wide net here. And on top of that, these letters are assessing proposed penalties in some pretty high amounts in some circumstances. The highest one that I heard of was over $40 million. I've personally seen them over $5 million, $10 million, and even $15 million. Now, I say all this not to scare you. You should not be scared or insanely worried. You can go to sleep tonight in peace. The fact of the matter is, at least for the 2015 calendar year, the IRS has been very cooperative. And if you can prove to the IRS that you actually complied with the employer mandate, despite your inaccurate tax forms, the IRS has, at least so far, been willing to dramatically reduce those proposed amounts and in some circumstances even completely zero out the proposed assessment. So you are not necessarily stuck with these big penalty amounts just because you received a letter. But I have been warning clients that they should be very diligent about these filings in the future, and they might even want to consider refiling their tax forms if they made some material reporting mistakes, which I'll discuss soon. And there are a couple of reasons for this. First, it is never fun to deal with the IRS and have to dedicate the time and resources to resolve the matter. Even if you ultimately zero out the assessment, you have to deal with the stress and headache of this process. And I hate to say it, but you might actually also incur some attorney's fees in the process as well. I like to think that I'm a pretty fun person to interact with, but you probably would not have much fun with me if we're going to be talking about a nasty IRS letter that you received. And my second point is that the IRS has been cooperative this year because it is the very first year of enforcement. There's no promise they're going to be so forgiving in future years. So I suggest you consider at least refiling your 2016 and 2017 forms if you made one of the two reporting mistakes I'm going to outline in this presentation. I should make a quick note, though, that the IRS will be enforcing the 2016 calendar year literally any day now, and that might be happening as early as tomorrow. So we're getting very close to it being too late to refile the 2016 forms, unless you really wanted to expedite the process. But we do have some time with respect to those 2017 forms if you wanted to refile. So let's get into the first mistake that I'm seeing that has triggered some pretty high proposed penalties. This by far, in my mind, is the biggest issue, and in my mind, the easiest thing to fix. So if you don't take anything else away from this presentation, if you were sleeping, I'm going to wake you up now and you go back to sleep in 30 seconds. This is the most important thing. Remember that form 1094C that I mentioned? That's that 3-page form that acts as a cover page. In a nutshell, this form literally asks you, have you complied with the 95% offer requirement by checking a box, yes or no. If you leave the box blank or accidentally check the no box, Even though in practice you actually comply with the employer mandate, the IRS views this as you not complying with the 95% offer test. Again, that's for 2015, that percentage is down to 70%, but for future years it's 95%. So this means, let's say, for example, if you left your 2017 Form 1094-C blank on this line such that you didn't check either box, and let's say you have 1,000 full-time employees, the IRS might issue a letter proposing penalties over $2 million simply because you didn't check a box. So my advice is to go back on those previous forms you already submitted and see if you checked the no box or if you left it blank. And if you did, you might want to consider refiling if in fact you did comply with the employer mandate. And of course, you should also pay really close attention to this, at least for your future reporting. So reporting error number 2. Now we're talking about those W-2-like forms that you are issuing at least to all your full-time employees, the Forms 1095-C. Again, these are the forms that IRS will use to assess whether that specific individual being reported on was offered affordable health coverage. There is a line on this form dedicated to safe harbors and other relief that the employer can assert to say it has a defense to any sort of ACA penalty. Line 16, as you can see there, literally permits you to tell the IRS, I am not subject to penalties because I have a defense against any penalties. And this is done by use of specific codes laid out in the reporting instructions. This could be because the employee was not full-time for a particular month, or that perhaps you satisfy a certain affordability safe harbor, or maybe the employee was in a waiting period for a few months. Whatever it is, line 16 gives you the opportunity to say you are immune from penalties. I have seen several IRS letters get triggered because the employer just left line 16 blank for all of its employees. Again, the IRS sees blanks as a failure to comply. So I would suggest you take a sampling of your Forms 1095-C that you previously filed. Again, it can just be a sampling. You don't have to rifle through all those forms. But take a sampling and see if you generally put in codes in line 16 on your Forms 1095-C. If you didn't, I would suggest you consider refiling or at least pay close attention to this issue moving forward. So I will get off my soapbox on the ACA now. And the primary focus of my presentation really was to alert you guys to these new IRS letters and give you some tips on how to tweak your ACA tax forms. But I wanted to take just a minute or two to discuss another area of increased enforcement, and that is HIPAA compliance. We are currently in the middle of an HHS audit where it is randomly selecting organizations to audit for HIPAA compliance. And I want to hammer home the point that employer-sponsored health plans are part of this audit process. I don't have time to go through my fun HIPAA mythbusters for you, but the punchline here is if you sponsor a self-funded health plan, you have some pretty significant HIPAA obligations, and you should take them seriously because HHS could investigate your health plans. Again, this isn't a situation where I'm trying to scare you or anything like that, but I do feel like in the benefits world, many think HIPAA is just for hospitals or insurance carriers. But I can tell you from personal experience that HHS does also investigate employers concerning their self-funded health plans. And that includes HIPAA privacy as well as HIPAA security. Again, I wish I could get into some of these terms and explain everything in more detail. When I do HIPAA privacy training, I at least take an hour on this stuff, so we don't have the time. But again, I wanted just to propose some red flags for you to embed inside your head as you're thinking about HIPAA on a normal course of business when you're dealing with your self-funded health plans. So my last slide here, again, I don't have much time left, but I wanted just to provide a short list of really important items that your organization should have if you sponsor a self-funded health plan and you want a strong basis if you're ever faced with a HIPAA audit. As I note at the bottom of the slide, this is definitely not a comprehensive list. Again, not a comprehensive list. I have seen HIPAA compliance checklists that are 10 to 20 pages long, but what I've done here is put together a list of items that I think are just critical, either based on my own experience as a practitioner or coming directly from the mouth of HHS as part of its current audit protocol. So I want to provide this list to you, and perhaps you can use it as a springboard for a discussion on HIPAA compliance within your organization. So with that, I will pass it on to Kayla for the CLE codes.
Thank you, Nick. For those of you who are seeking CLE credit today, I'm going to open the next screen, which will allow you to type in the code on the box. I will go ahead and read that code now. That is JM4T6. Again, J as in Jaguar, M as in Mary, the number 4, T as in tree, and the number 6. I'll leave this open briefly. And just a reminder to those of you who need Kansas, New York, or New Jersey CLE credit, please also complete the attorney affirmation form. All CLE certificates of attendance will be distributed to eligible participants in approximately 8 weeks. One more time, that's JM4T6. And I'll leave it open just for a second, and then we'll turn it over to Caroline. All right, Caroline.
Good afternoon, everybody. I'm going to be discussing tips for drafting an effective and compliant employer handbook. I'm going to give you some do's and don'ts for employee handbooks, look at what's going on in the National Labor Relations Board, identify some policies that probably need some updating for just about every employer given what's happening with the law, and then briefly discuss how employee benefits should be presented in an employee handbook. So let's face it, employee handbooks are often a neglected and underappreciated company document. It's not the first thing on anybody's list for what they want to do, but preparing and maintaining or updating a handbook that reflects your company's policies and how you operate is important, and it takes time and expertise. A well-written handbook can be an effective document that ensures compliance with applicable laws as they evolve and as new laws go into effect. And an outdated handbook can be a liability. So at the outset, I've provided some do's for employee handbooks. Some bullet points may appear obvious, but frankly are often not reflected in companies' handbooks. So first of all, provide an overview of your company that introduces employees to the organization. I'm amazed at how frequently organizations fail to promote and highlight their business, their mission, their purpose within their handbook. After reading an overview, an employee should really feel a sense of pride that he or she was hired by the organization. Draft the handbook so that it's organized, easy to read, user-friendly. Use plain language. Of course, disclaimers are of the utmost importance, and I've set forth the key disclaimers that should be in any handbook, including at-will employment, not a contract of employment, will not cover every conceivable issue, policies may be revised at the company's discretion, and that the current version of the handbook replaces all other handbooks. The handbook should really set forth the expectations for employees, for attendance, conduct, discipline. However, make sure that you include language that retains discretion and flexibility for the company. So here are some more do's for employee handbooks. Remember to take the time and make sure to obtain a written acknowledgement from the employee. Close that loop. If you've taken the time to prepare an excellent handbook, make sure you take the time so that the employee specifically acknowledges that they've received the handbook, they reviewed it, they've had a chance to ask any questions, and they acknowledge that they are at will and that the handbook is not an employment contract. My next bullet point is on applying policies consistently. And although there is a saying that consistency is the hobgoblin of small minds, Consistency is critically important in employment law in order to avoid disparate treatment claims, so apply policies consistently. My next bullet point is on considering state-specific supplements. With all the numerous state and local laws such as paid sick leave law, parental leave, which I will discuss a little bit in more detail later, consider whether a state supplement is preferable for your organization given the various locations of your offices or facilities. Another very important point is to view your employee handbook as a potential exhibit in litigation, because it often is. I've handled many administrative charges, and it really sets the tone for the litigation when the employer can show a clearly written policy that was violated, the employee is acknowledged receiving the policy, understanding it, and even better if there's been training on the policy on such and such a date. So my final bullet point for dues is to regularly review and update your company's employee handbook. Don't let it sit on a shelf collecting dust. It really is a living document. And when updating, obtain the assistance of your HR and IT personnel as well as employment counsel. So just some quick don'ts for employee handbooks. Don't take a cookie cutter approach. Your company is unique, and your handbook should reflect your company's business and culture. Yes, there are many standard provisions in a typical employee handbook, but avoid using some other company's handbook or template without thinking about how each and every provision impacts your employees and the culture that you want to create. Don't make promises in your handbook that could give rise to liability, such as a promise to provide annual performance reviews or to hire from within the organization. Use permissive rather than mandatory language. An example would be employees generally receive an annual performance review instead of employees will receive an annual performance review. Don't be overly restrictive. Retain full discretion to take whatever action you consider necessary and appropriate under the circumstances, and no list that you provide in a handbook should be exhaustive. Again, don't forget state and local law considerations. I sort of said that twice now. And I've just given some state laws that may implicate or indicate that your handbook may need some tweaking. Paid sick leave, jury duty. Some states have a requirement that jury duty is paid for full-time employees. Nursing mothers, there are currently 29 states that have laws relating to breastfeeding mothers. So there'll be a little bit more later on employee benefits, but the specific overarching theme with presenting employee benefits in a handbook is don't be too specific. Less is often more. So my final don't is don't forget to train your supervisors on how the handbook will be used by the company. So let's move to a little bit of information on what's happening with the NLRB, which is actually pretty significant. In December of 2017, the National Labor Relations Board issued a decision, which I have on the slide, the Boeing Company, which impacted employee handbooks as well as the validity of employee rules and policies. Essentially, the board recognized that its prior rulings, which had found, for example, many civility rules unlawful, created a conflict for employers who are responsible for protecting employees from harassing behavior. So in the Boeing decision, the board issued a new standard and will now consider whether a facially neutral rule, when reasonably interpreted, would interfere with rights under the National Labor Relations Act. If so, the board will now strike a balance between the nature and extent of a challenge rule's potential impact on rights to engage in protected concerted activity under the Act, and also assess the legitimate justifications associated with the rule. The decision laid out three categories, which are on the next slide, into which the board will classify rules. This ruling was significant because it really swung the pendulum back toward the employer. And then on June 6th, the NLRB's General Counsel issued a 20-page memorandum entitled Guidance on Handbook Rules Post-Boeing, and this provided helpful guidance to employers. Of particular interest, the guidance specifically said that ambiguities will no longer be interpreted against the employer. Again, this was you could hear a collective sigh of relief from employers all across the country. So I won't go into too much detail on this, but just wanted to point out the three categories that were set forth in the Boeing decision and the NLRB GC's guidance, which really impacts employee handbooks. And in particular, if you take a look at Category 1, this category are rules that are lawful because they do not restrict rights under the NLRA or because the justification for the rules outweigh their tendency to restrict those rights. So again, very helpful for employers who are either updating their handbooks now or drafting a handbook. So now rules that are generally lawful include rules requiring civility, rules prohibiting photography or recording, rules against insubordination, employees being uncooperative with their supervisors, conduct that adversely affects operations, disruptive behavior, rules protecting confidential, proprietary, financial, customer information, rules against defamation or misrepresentation, rules against the use of an employer logo, rules requiring authorization to speak for the company, rules banning disloyalty. All of these rules will now generally be considered lawful to maintain. And again, this really is a very helpful guidance and a sea change as to how employee handbook rules were viewed prior to this decision in 2017. If you look at the next category, rules that warrant individualized consideration, the example that the General Counsel gave, for example, is, confidentiality rules. If your rule broadly encompasses employer business or employee information, it may get some individualized scrutiny as opposed to a confidentiality rule where customer or proprietary financial information that's not in the public domain is specifically targeted. And of course, under Category 3, rules that restrict employees from talking about their wages or benefits or working conditions will be unlawful to maintain. So that's where the NLRB currently is at. Let's talk about some policies that may need updating. And the first policy identified should come as no surprise to anyone. It's your anti-harassment policy. I have already revised and updated many anti-harassment policies. Allegations of workplace sexual harassment and assault have made headlines nationwide. It's brought down the careers of numerous high-profile executives and politicians. And in boardrooms, directors and trustees are really grappling with how to respond. A good place to start is with your company's anti-harassment policy. Your company's policy can really help set the tone and expectation that your company is committed to maintaining a workplace that is free of harassment. Typically, policies in handbooks, provisions in handbooks should avoid legalese, but our recommendation is that this is one policy where the company should explain what constitutes sexual harassment under the law, quid pro quo, hostile work environment, but also then explain what type of conduct will violate your company's policy. In other words, sometimes conduct that may not rise to the legally actionable level of harassment can still violate your company's policy against harassment. So it's helpful to have not only definition of what constitutes sexual harassment under the law, but also provide some examples for what type of conduct will not be tolerated by your company. Recent high-profile situations have shown a light on why women don't report harassment. And there are a myriad of reasons. Women don't want to take the risk alone. They fear retaliation. They don't know whom to report it to. They don't think anything will be done. They just want the conduct to stop. A robust anti-harassment policy should have a number of channels for complaints and not just the supervisor. Oftentimes, the supervisor doesn't properly elevate the complaint, and of course, there needs to be another channel if the supervisor is allegedly the problem. So we are advising employers to set forth a number of people in positions of management, for example, the Human Resources Director, the Vice President of Operations, even the CEO or the President, depending on your business, the size of your business, organization. And as part of your policy, include that individual's telephone number, email address, and it's helpful if both genders are represented, again, in a number of avenues or channels for where employees can bring complaints. You got to make sure all the folks who are identified are then trained to know what to do if an employee comes to them with a complaint of harassment. The policy should confirm that all complaints will be promptly and thoroughly investigated, confidentiality will be maintained to the extent possible, and of course, there will be no retaliation against anyone who brings a complaint in good faith. So the next policies that I've identified that might need some tweaking or updating are leave policies, FMLA, paid sick leave, parental leave. The FMLA requires employers who have an employee handbook to provide notice within that handbook regarding the FMLA. Not only employee eligibility, but how an employee will receive notice as to whether or not the leave is covered under the FMLA. As for paid sick leave, right now I think we're up to at least 9 states and multiple other localities that have enacted some form of paid sick leave. What's interesting is that there's also an opposing trend of state governments, Wisconsin is one of them, that have prohibited local governments from enacting paid sick leave requirements. There are just a myriad of requirements that differ state to state, locality to locality, so employers must carefully review applicable laws to confirm compliance. Same along the parental leave law. Your policy should apply to all types of new parents, understanding that there's a distinction between paid leave for recovering from childbirth and paid leave for bonding or other non-medical issues. Paid leave for bonding needs to be gender neutral. So you want to make sure that your leave policies are not inadvertently discriminatory. So additional policies that may need updating include your policies that protect LGBT employees against discrimination. Right now, there's a split amongst the circuits as to whether Title VII covers claims of sexual orientation discrimination. Many states already protect against sexual orientation discrimination. Wisconsin has since 1982. Whether or not it's the law for where your company is located, if you want your company to be an inclusive workplace, update your policies or make sure your policies protect against discrimination and harassment based upon an employee's sexual orientation, gender identity, or expression. Reasonable accommodations, again, an employer's obligation to provide leave sometimes could extend beyond the 12 weeks under the Family Medical Leave Act, depending on whether or not an employee has a disability that may be covered under the ADA. So you just want to avoid any sort of blanket statements in your policy that may not indicate that the interactive process will be used if necessary for a particular employee's medical condition. On this slide, another evolving area of the law involves marijuana, which implicates drug testing, substance abuse policies in your facility. Stay aware of state laws addressing medical marijuana, recreational use of marijuana. Sometimes we saw it in Massachusetts recently. A state law disability statute can provide a vehicle for employees with a disability discrimination claim. So the final policies that I've indicated, and I'll just go through these quickly before getting to my final slide. Confidentiality policy, social media and weapons policy. Discuss a little bit about confidentiality given some of the new guidance coming out of the NLRB. Again, needs to be directed at financial or proprietary customer information that's not in the public domain. Social media policy, given the NLRB's recent guidance, stricter handbook policies on social media may be considered enforceable now under a Trump administration. And as for a weapons policy, I've identified a state law that you find in a variety of states where employees are permitted to keep a licensed firearm in their vehicle in a company's parking lot. So if your facility is in one of those states that has one of those laws, you want to make sure that your policy is compliant with that. So very briefly on how to present employee benefits in a employee handbook. A brief description really is all we recommend. In fact, a list of what is available is sufficient, but be clear that benefits are subject to eligibility requirements of the employee and the individual plan. Refer the employee to the summary plan description or the SPD as the controlling document for each benefit plan, not the handbook. In other words, the SPD controls, not the handbook. Make sure to reserve the right in your handbook that you can change, revoke, terminate any employee benefit, and also refer the employee to the appropriate department or position for any questions that they may have. With that note, we're at 1 hour, and so I'm going to turn it back to Casey in case there are any questions for the remainder of our presentation. Thank you very much.
Great. Thank you so much. So we do have a couple of questions today, and the first question we received, Nick, is for you. So unmute yourself.
Okay.
So Nick, if we have a parent company and 3 subsidiaries, how does ACA tax reporting work?
That's a good question. So to determine if you're a large employer subject to the employer mandate, you got to look at everyone, all the companies within your corporate family, if you will. The fancy tax term is your controlled group. But pretty much those companies that share common ownership, you look at the employees within all of those companies to determine if you're a large employer subject to the employer mandate. After you have done that, the parent here and the 3 subs would actually report separately. So you do the reporting on an EIN by EIN basis. So if you have a parent and several subs within your corporate family, the parent and those subs should report separately. They should be doing the 1094C and the 1095Cs for just their own full-time employees. You wouldn't want to do it on the entire corporate family basis when you're doing that reporting. It is EIN by EIN.
Great. Thanks so much. Caroline, it looks like you're next. So given the various state and local laws on issues like paid sick leave and parental leave, for a multi-state employer, what is your advice for drafting a policy that covers all employees?
This is a great question. And first of all, you need to determine whether you really want a one-size-fits-all policy and whether it makes sense to do that. The answer will depend on how many states, localities are involved, given where your offices, facilities are located, how different the requirements are in those jurisdictions, and how important it is to your organization to have a single policy. Trying to use a single policy means that you will have to commit to the most generous, the most employee-friendly options in each jurisdiction, including those locations where the law may not require such a level of generosity to the employees in that location. So, for example, I know for a national company with a location in, in Montgomery, in Montgomery County, Maryland, this would mean deciding to give every employee up to 80 hours of paid sick leave per year. That's the permitted cap of leave under Montgomery County, and you may not want to do that. So in making this, you may not want to do that for employees who don't reside in Montgomery County. So in making this decision, you've got to ask how much the company values uniformity throughout its organization as compared to the importance of minimizing cost associated with paid sick leave. So a better approach may be for many multi-state employers is to have a one-size-fits-most policy that then allows for supplements or variations for a particular jurisdiction.
Great, thank you. Very helpful. Okay, the next one is for me, and the question is, are ISOs subject to Code Section 409A? That's a good news answer, and that good news answer is that no. ISOs that satisfy the requirements of Code Section 422 are automatically exempt from Code Section 409A. The only time you really have to worry about this is if that option is later modified or extended. You have to make sure that that new modified or extended option continues to satisfy the requirements of 422, because if it doesn't, it'll be treated as our non-qualified stock option. You'd have to go through the standard 409A analysis with respect to that option. Okay, I think we might have one more for you, Nick, and then we can give everybody their day back. Let me just pull that up. Okay, so Nick, in what type of situation would any employer offer health coverage to less than 95% of their full-time employees?
Okay. Well, I think the first thing to consider is if you are a large employer subject to the employer mandate. And again, as I mentioned in my presentation, we're talking about, generally speaking, an employer with at least 50 full-time employees, including full-time equivalents. And again, high level, full-time is generally, we're considered on average you're working at least 30 hours per week. So if you're not a large employer subject to the employer mandate, obviously that incentive goes away. So you might not want to offer coverage or might not feel required to offer coverage based on your budget constraints to 95% of your full-time employees. If you are a large employer, this isn't a situation where it's compliance penalties. You know, I talked about HIPAA a little bit today. If you have a data breach or you have a material non-compliance with HIPAA, you go on the wall of shame. HHS has a place online where you have to report that you had impermissible protected health information disclosures, and these are considered non-compliance fines. In contrast, the employer mandate, there was a huge Supreme Court decision on this. They struggled to say, is this a tax? Is this a penalty? What is this thing? And, you know, our everyday industry terminology, we call these things employer mandate penalties, but they're really called employer shared responsibility payments. And so there's not it doesn't compel you to offer coverage to 95% of your full-time employees. But if you don't, there might be some significant potential tax exposure, as I mentioned in my presentation. And I think what I said in my presentation, if you just take, for example, 2017, calendar year 2017, and you don't offer health coverage to at least 95% of your full-time employees, you're looking at potential tax penalties if the IRS were to audit you or to send out a letter assessing penalties of over $2 million. So again, we call it in industry terms the employer mandate because the penalties are pretty stiff. But again, it's not seen as any sort of criminal concern or a noncompliance violation of any sort like that. But again, it's more of a weighing cost and benefits and figuring out, you know, do I really want to get to that 95% threshold so I don't have to worry about potential tax exposure?
Great, that's really helpful. And I think, Nick, your distinction between is this a tax, is it a penalty, is it a compliance issue is really important also in a world where I work a lot, and that is the transaction space. So if anyone on the phone assists in any corporate transactions, mergers, acquisitions, an important thing to remember related to what Nick said is that if you're looking at your representations and they are sort of what we would consider to be more standard reps that cover tax violations or compliance breaches, we do recommend that you stick in some very specific language around the Affordable Care Act because of this distinction between, what those assessments really qualify as. Okay, so I am going to let everyone go. We have about 4 minutes left in our time. We did receive some additional questions, which we will be sure to respond to everyone or the submitter by email. And if you think of anything in the meantime, please feel free to contact any of us independently. Thank you so much for joining us, and have a great day.